Welcome to the InterMarket Analysis video update. This is a video that I do every week where we look inside the S&P. We mainly look at historical and forward-looking valuation levels. We also do a pretty in-depth look between growth and value. And then we look at other markets outside of the S&P to see if they're giving us some insights as to what's happening ultimately within the S&P. This is being prepared for Monday, November 25th. Before I get into that, I want to tell you about a thing called the SPXInvesting Program. It's up, it's going, it's free until the end of 2024. There's a link that will take you to the website or to a video. There's also an email address here where you can contact me if you have any questions. Also, the daily video is where I do the main part of my analysis and commentary. This intermarket analysis video is just one of the weekly videos that I do, but everything is meant to tie into the daily video. Okay, let's go and look at S&P 500 valuation. Now, this looks historically, and it shows things with a PE ratio of 10, 15, and 20. Those are static levels. When we're at 10 or below, the market is considered to be inexpensive. Between 11 and 19, the market is more fairly priced, with 15 being the sweet spot there. And then 20 or above, the market is considered to be expensive. We are expensive. We're well above the red dashed line, but we've been that way for years now, and things are pretty positive right now since the election. We had the really strong week right after the election. Then last week was kind of, uh-oh, things were kind of exhausted at that point. And even a large part of this past week, things didn't look all that great. We were seeing mixed signals, positive and negative. Well, we saw some strength coming in on Wednesday. We saw things hold together on Thursday and actually look pretty positive on Friday. So as of right now, we're looking pretty good, but we're coming into the week with Thanksgiving in it, so we may see volume really drop off. But we can stay in this overvalued situation for a long period of time. I don't use this to make decisions. I don't use it as any kind of a timing mechanism because you would miss out on so much. But this is just more for informational purposes. Then we also plot this using different events that have happened going back to 1980 and what the valuations were. Then Robert Shiller took a variation of the PE ratio and smoothed it out by using earnings over a period of time. And he's come up with his own version of this. And currently it's coming in at 38.07. It's really been going up. Well, that's pretty high. We're getting not quite up to where we were during the dot-com boom and ultimate bust, but this is really going up to where we were near the end of 2021. Also, to give us a little bit more context, we can look at the median and the mean between 16 and 17 roughly, and we're more than double what the median and mean are. So this also suggests that we're expensive on a historical basis. But the market doesn't do that. They look forward, and these are analyst projections and forecasts of what they think will happen going forward. And that's what the stock market uses. We have four different ways of looking at this here. First, we look at the Mega Cap 8, and this chart's put out by Edward Yardeni at yardeni.com. And that's the purple line here. And these are the big stocks, the Nvidia, the Google, the Apple. And they're coming in at 29.1. That's way above that 20 level. And then we look at the S&P, which is in red. It's coming in at 22, which is well above 20. And we're seeing some improvement now with the mid caps and the small caps. That's the blue line and the green line here. With the mid caps coming in at 17.1. They've been camped out around that 15 level for a while, as were the small caps, and they're going up too at 16.9. So this is why a lot of folks have been waiting to get into this area, because these stocks are not necessarily expensive. And a lot of people do use this to make decisions. I don't. I just use it for information. Then I use technical analysis to tell us what's going on with the market. But we need a better economic environment for the mid caps and small caps to do better. We thought it was going to happen a year ago, and we've had a number of false signals. The mid caps and small caps did improve this week, but is this another false signal? Is there going to be more follow through with this? Well, if they do continue to go up, then we'll see this PE ratio also going up. All right, then we look at growth versus value. First, I look at growth all by itself in a solid uptrend. Then we look at value all by itself, not a real strong uptrend, but still in an uptrend. The insight is when we do ratios between the two. And in a more positive environment, we want to see longer term growth outperforming value, even though it came down a little bit this week. Then, just to show it in a little bit different way, I do an inverse of that same ratio, showing how value is underperforming growth. And then the next series of charts after this are just different ways of looking at growth versus value. So we look at some ETFs, showing how value continues to outperform growth and how growth is outperforming value. And here is where value is underperforming growth. And we look at some indexes, the same index that I looked at earlier, but now doing a ratio, showing how growth is outperforming. Also seeing how growth is outperforming, even though it's pulling back. And we're seeing more broad participation in the market right now, instead of just the real big name growth stocks that are doing the best. They've actually been underperforming lately, but they're still outperforming longer term. This is looking and showing how value is underperforming growth. And then we look at a value versus growth ETF, showing how value continues to underperform, but it's coming back up into the rainbow. And then we look at a growth versus value ETF, and I show this in the daily video, coming down a little bit into the top end of the rainbow, but still looking pretty solid. You see where we really went up over the summer? And ever since then, the mega cap stocks and the large cap stocks, they've been underperforming, even though they're still doing quite well. It's the rest of the market that is now coming in and starting to participate. And we look at small cap growth to value, still in a downtrend, but showing a lot of improvement, as we're seeing the same thing here with the mid caps. Downtrend, but improving. And in an uptrend, when we look at large cap growth to value, but it's not really breaking out right now. We keep an eye on inflation. And we look at a monthly chart of the CRB index, and it's actually ticking up just a little bit, but I mainly follow the moving average here where that's flat, not really suggesting that inflation is a problem as measured by this. And we're continuing to go down with the inflation deflation ratio. So that's also showing how inflation is going down when compared to deflation. Then we look at a daily chart here, the CRB index, and it really shot up here, but we're still in an overall downtrend with the blue line below the red line here. Then we look at this called the Baltic Dry Index. As a general rule, this is how much does it cost to ship things. When this is going up, that's more inflationary. When this is going down, that's more deflationary. And it's actually been going pretty much sideways to slightly declining lately. Then what are the inflation expectations? This is a weekly chart that we look at here. Not quite back to where we were about a year ago, but still coming up. There are some concerns about inflation. Now, that doesn't necessarily mean the end of the world. Inflation is a natural byproduct of a healthy economy. And if the economy still does pretty good, inflation can still go up as long as inflation is not going up faster than the economic growth that we're seeing. And interest rates can be higher too during good economic growth periods. So we keep an eye on these other markets like aluminum, which is in an uptrend right now with the blue line above the red line. Corn is bouncing back up, but still in a downtrend. Wheat is also in an overall downtrend. So these are not necessarily inflationary here. Fertilizer has been dropping off lately, so that's not really inflationary. I've been watching oil mainly for geopolitical reasons based on what's going on between Iran and Israel right now, but oil really hasn't been moving all that much. We look at a ratio between gold and oil. When this is going up, that means gold is outperforming. And we look at a correlation. The red dashed line, this is oil, and then the 10-year yield. And you can see that there are periods of time when this correlation is really strong. That's when we get really high readings with this bottom area of the chart. Right now, they're having a tendency to go in opposite directions. So if interest rates are going up, oil's been going down. That means they're going opposite. So right now, it's not what we typically see with this type of relationship. Gas is in an overall downtrend now, which is good. You get the busiest travel week of the year coming up. And diesel also has been not really going up all that much. It's actually been going down. Heating oil also coming down, which is nice now that things are turning colder. Natural gas is actually starting to go in an uptrend here. And we look at copper. Now, this is a little surprising. There's a lot of folks out there that think the economy is going to be strong. Well, if that was true, according to this chart, copper should be going up, and it's actually going down. And on the daily chart here, we're seeing a death cross. So it's actually gone into a downtrend. That's a little bit of a concern. We want to keep an eye on that. We want copper to show strength going forward if we're more positive on the economy and ultimately the stock market. And we look at a copper to gold ratio where gold's been going up as copper's been going down. That's why we're seeing this ratio really going down as copper underperforms. This is long term, where you can see going back, there's times when the 10-year yield and the 2-year yield, they pretty much go in the same general direction. For the last number of years, they've actually been going in opposite directions. The copper to gold ratio has been going down as interest rates have been going up overall. And we're seeing a general change in the overall economy that's still trying to be worked out. And of course, everybody has an opinion about what will happen. We're just keeping an eye on this for now, but we're not really coming to any conclusions yet. Gold is really looking solid right now. Silver still in an uptrend, but below its 50-day moving average. We look at the closing price for gold and the closing price for silver, and we see that the correlation between the two is pretty strong. They're typically going in the same direction at the same time. And we look at a gold to silver ratio on top. When this is going up, gold's outperforming. When this is going down, silver is outperforming. And then what's interesting about this is we can see the interplay between precious metals on top and the US dollar index in the middle area. And it's a strong relationship here. It could be getting stronger as we just watch precious metals as compared to the dollar. And then speaking of the dollar, it's just been really going up. Actually, since the beginning of October, it's really been seeing some strength here, and then it's just kept going up after the election. We're still in a technical downtrend here because this purple line is below the orange line. If we cross back above here on the daily chart, that would be an uptrend, but we're not quite there yet, even though the dollar has been really, really strong lately. And some of that can be said for, okay, we got through the election. It seems like the system worked, where there was a lot of doubts 4 years ago about how everything worked out. And with Trump coming into office, he's a businessman. And so there is some anticipation that the economy is going to get better. There's a lot of talk about doing some changes that the market seems to like. So when you take all that together, that's when the value of a country's currency will actually go up. And we're seeing the euro really coming down as the dollar's been going up. And we're seeing the Japanese yen coming down as the dollar's been going up. And then I break these out. We're still in an uptrend, barely with the euro. Another week or so, we could actually see the euro in a downtrend. This would be more advantageous time to actually go to Europe. The closer we get to 1.0000, that means they're at parity, which means the euro and the dollar are about the same. And you can get a pretty good exchange rate if you want to go to Europe and use the euro. And the Japanese yen is still in an uptrend compared to the dollar, but it's really been pulling back. It can also be a pretty advantageous time to go to Japan. And if you want to go to Britain, it's still in an uptrend the way we measure it here, but we're falling below both the 50 and 200-day moving averages as the dollar's been strong against these other three currencies mainly. There's lots of currencies, but it's the euro, the British pound, and the Japanese yen, the major ones. And we look at some index ratios, and I show this in the daily video. And what we're seeing here with the red line going above the S&P weighted version of the index is that this is the broader market actually outperforming. Now, we'll see if that can continue. Can it stay above the bar chart that we see here? That means more stocks are participating in a particular move. And in this case, it was to the upside. Then we look at a ratio between the equal weight and the S&P 500 weighted, not really breaking out. It's been chopping sideways over the last few months. And we look at stocks versus commodities. This continues to show how stocks are outperforming. We do an inverse showing how commodities continue to underperform stocks. We look at the NASDAQ 100 and compare it with the S&P 500. Both are doing really well, but the NASDAQ 100, after really going up last summer, has really been starting to underperform enough to give us a death cross here with this ratio, even though independently, they're both doing really well. The S&P 100 is still outperforming longer term the rest of the S&P 500, but it's really dropping back As we saw later in the week, the large caps were underperforming the small and mid caps. The NASDAQ, this is potentially positive here, where the NASDAQ is starting to outperform the S&P 500. Again, both are doing really well and off recent all-time highs. But if this could continue to go up and we go up with this ratio, that means the NASDAQ is outperforming, and that tends to be more positive for the market, including the S&P. But then we show how the NASDAQ 100 is now underperforming the rest of the NASDAQ. So where the NASDAQ 100, it was really strong back in 2023, it's now kind of being pushed back as the rest of the NASDAQ, which is a much bigger index, is actually outperforming now. And we look at mega caps versus the equal weight, pretty much going sideways right now, as the mega caps have slowed down in their leadership role in the market. Small caps looking really good here, but still in a longer term downtrend. What would be more impressive is if we continue to go up with this ratio and eventually see the blue line cross above the red line, but that still hasn't happened yet. The big software companies also looking pretty solid right now. And then we look at a ratio between small caps and the S&P 500, still going down even though it's improving. And then the blue line is the S&P, and see how that's been going up as this ratio has been going down. If this ratio continues to go up, that would be more positive for the small caps and probably more positive for the S&P, since they would both be going up. Mega cap growth, these are the really big companies, still looking really solid when you look at them all by themselves. Robotics and AI ETF coming up out of the rainbow. And then we look at the Dow Jones Composite Average. This is the Dow, the transports, and the utilities taken together, setting an all-time high here. And then I should have had this chart earlier. Seeing a bit of an improvement here when we do a ratio between the robotics and AI ETF with the tech sector, but it still hasn't really broken out above the rainbow yet. The tech sector's still been outperforming. Small caps to the tech sector showing an improvement here, but doing a lot of chopping sideways right now. And then we look at the advanced decline line, showing a lot of improvement, especially after Friday. We're back above the moving averages with the NYSE common stock, S&P, mid caps, and small caps. And not quite back to an all-time high yet with traditional Dow theory, or looking just at the Dow itself. The transports are showing some improvement, and we saw a little bit of strength coming back into the utilities, but then some weakness in Friday's session. The transports looking better than they were. They came and set a recent all-time high here. Now, can they continue to go up? And that would mean that the economy is looking stronger. Then we do a ratio between the Dow and the transports. When this is going up, that means the Dow's outperforming. Now, lately, the transports have been doing well, so we're seeing this ratio going down. Then we do another ratio between the transports and the S&P 500, pretty much chopping sideways right now after declining for quite a while. And then we look at, instead of using the Dow, we look at the S&P 500, not quite back to an all-time high. Instead of using the transports, we use the NASDAQ, also not quite back to an all-time high. But when you look at the S&P equal weight, that did set a new all-time high in Friday's session. That means the rest of the stocks in the S&P are improving, so the weighted version is actually lagging a little bit behind the equal weight version. Now, we'll see if that can continue. When we look at the equal weight version of the QQQs, we haven't come back and set an all-time high here yet. So it's a non-confirmation at this point. And we look at the correlation between the transports and the S&P, pretty strong correlated relationship when they're up in this red area. The FANG index, not back to an all-time high yet, but still looking solid. And when we look at the FANG index, we're still below this short-term trend line and above this longer-term trend line. And this has been providing some support when we go down. It's also been providing some resistance as we've been going up. We'll see if we can break to the upside, or are we going to break to the downside, or just kind of chop around in this channel for a while. The Wilshire 5000, another broad market measure, not in an all-time high yet, but pretty close, and also near an all-time high with the total U.S. stock ETF. Low volatility stocks, looking at them all by themselves in a really solid uptrend. But when you compare it to the S&P, continuing to underperform. ARK actually was up pretty solid in Friday's session and up pretty good for the week, enough to generate a golden cross here in the short term. And we're starting to see a golden cross on the weekly chart as well. Then you look at the whole world ETF and take out US stocks, coming back down to their 200-day moving average here. And this just shows when we do a ratio how US stocks are continuing to outperform world stocks. Then here's another world measurement that we look at, the S&P versus another index of stocks in Europe, Australia, Asia, and the Far East, showing how US stocks are really outperforming. And we plot an oscillator on here, which continues to go up as well. Then we look at bonds here. We're coming back down to the 200-day moving average here based on price. Is this going to provide some kind of support level? Falling back based on price, but still above the 200-day moving average here with the total bond ETF. And chopping around, still in an uptrend, but really seeing some weakness with the world bond index. But when you look at a monthly chart of stocks versus bonds, stocks are clearly outperforming still longer term. This also is a daily chart showing how bonds are underperforming stocks. Then high yield bonds, junk bonds, not quite at an all-time high yet, but still looking really solid. Then investment grade bonds, more conservative bonds, pulling back based on price, but still in a longer term uptrend. We look at a stock to bond correlation coming down a little bit, not really strong right now. Typically, if this gets a high reading, that means stocks and the price of bonds are going in the same direction, either up or down at the same time. If we drop below this blue line, as long as we stay in this area and don't come down to the red line, that will be neutral. The corporate bond index in a longer term uptrend, but has been pulling back based on price lately. And this is riskier bonds like junk bonds and more conservative bonds, still looking really solid here at the high end of the rainbow, even though it's been pulling back. Nothing really to see here when we do the fib retracement levels of the 10-year yield. Also, we've been up in a higher area now with the 10-year yield, and we're wondering, is it going to stay that way after 40 years of yields declining? This over here on the right-hand side, what we're dealing with now is more historically what it has been. Also, the fib retracement levels here with the 30-year yield not giving us any insight there. Junk bonds looking really solid by themselves. And then we do a ratio between junk bonds and government bonds. Junk bonds are outperforming after seeing some recent weakness. And this is a daily chart, and this is interesting. When we were really coming down with yields, and then the Fed cut rates, and now we've been going back up. Okay, kind of goes against what you would think would have happened there. This is a weekly chart looking internationally. No real changes here with the US, UK rates being the highest, followed by the German rates, which did decline. And then Japanese rates are in red. And we look at the S&P 500 and compare it with short-term bonds based on price. Stocks are outperforming shorter term. And we look at the S&P 1500, also shorter-term bonds as well, and stocks are outperforming. Another broad market measure with further out bonds showing how stocks continue to outperform. The tech sector, not breaking out right now, but still above the rainbow when we compare it to 3 to 7 year bonds. This is kind of an inverse of what we just looked at. This is showing how bonds are underperforming stocks. And then the S&P to the 10-year yield, where it's been in an uptrend overall here, but lately it had been pulling back. And then we look at the volatility of bonds as measured by the MOVE index. As we've been coming down with volatility, also as stocks have been going up, we've been coming down with the VIX, which measures the volatility of stocks. And we're getting kind of close to a neutral reading when we look at the top chart and compare it to the middle chart. Then we look at the long-term 30-year ETF based on price, still below the moving average. But when we do a ratio between the long-term bond ETF and commodities, bonds are still outperforming. Then we look at different sectors. And what I do here is I just look at the sector all by itself, and then we compare it to the S&P. Materials came almost down to their 200-day moving average and now bouncing back up as it's perceived that the economy is looking a little bit better. But when you compare it to the S&P, still underperforming and has a ways to go. Communication, one of the growth areas, and it's pretty solid uptrend when you look at it alone, and really breaking out and showing an improvement here, even though it has pulled back lately. And a lot of the growth stocks that we follow are in this sector. And energy, after coming down and dealing with its 200-day moving average and seeing not a death cross here that didn't last for very long, the energy sector has really been going back up, but it's still in a downtrend when we compare it to the S&P, even though it's improving. Financials, all-time high here with the sector and one of the stronger areas when compared to the S&P. Industrials also more economically driven. After pulling back, they've been showing some improvement here and holding up and still in an uptrend when compared to the S&P. The tech sector looking really solid all by itself and pretty much going sideways and even in a downtrend here when we compare it to tech. This really shot up over the summer and has been underperforming. Not that tech is falling apart. We can see here it's looking really solid by itself. It's just underperforming when compared to the S&P. Staples, toilet paper, toothpaste, bouncing back up above its 50-day moving average, but still underperforming when we compare it to the S&P. Real estate, trying to get back above its 50-day moving average, but underperforming when we compare it to the S&P. Utilities were really strong, pulled back, now coming on strong again, and in an uptrend, but kind of going sideways when compared to the S&P itself. And then we do an S&P to utilities ratio. I haven't been showing this because we've just been chopping around lately as the market figures out, okay, are we looking at a stronger economy? Are things going to fall apart? Is there going to be a nuclear war? Is there going to be an end to the war? Is things going to settle down in the Middle East? And so there hasn't been any real direction given by looking at this chart lately. Healthcare under a lot of pressure right now, but still in a longer term uptrend. But when we compare it to the S&P, really underperforming. Discretionary, and think of Tesla and Amazon.com. Coming back, but not quite back to an all-time high. But this area has really been strong lately and improving enough to give us a golden cross recently when compared to the S&P. Semiconductors. This is a little bit of a warning sign here. This is the SOX index or the semiconductors index here. We're actually seeing a kind of a light death cross here. We've actually crossed below. The blue line's below the red line. It's really hard to see. You have to look at the numbers over here on the left. This is a concern to us because this is a huge part of tech, and tech is a huge part of the market. We need semiconductors to do better for the market to stay more positive. Then we look at another ratio between energy and tech. Energy has been bouncing back up, but still hasn't broken up above the 200-day moving average, and energy is still in a downtrend when compared to tech. And we look at growth areas versus bonds here, and it just shows that growth stocks are outperforming. Tech sector versus the 10-year yield coming down to the 200-day moving average, but still in an uptrend, showing how the tech sector is outperforming interest rates. And here's an inverse of that, showing how the 10-year yield is underperforming the tech sector. Discretionary to staples, seeing a recent golden cross here with this ratio, and that's more positive for the market. And staples seeing a death cross when compared to discretionary. That's also more positive for the market because staples is more defensive or are more defensive. And the gold to S&P ratio, just kind of chopping around right now, but still in an uptrend when we compare gold to the S&P. Also, gold has been outperforming the dollar. Even though the dollar's been doing well, gold has been doing even better. High leverage loans. This is another tool that you can use to gauge the economy. It was down a little bit in Friday's session with this ETF, but it is not even coming back down to its 50-day moving average and in a solid uptrend right now. These are very risky loans, and if the economy was really getting ready to fall apart, we would not see this hitting recent all-time highs. The NYSE composite setting a new all-time high in Friday's session. All stocks not to an all-time high yet. This is U.S. and international stocks, but still looking quite solid here. Emerging markets coming back didn't quite get down to their 200-day moving average, but they were up slightly, tending to underperform right now. And the Japanese Nikkei index, it's just a whole jumbled mess over here right now. Not really breaking out, not really breaking down. Bitcoin, last I checked, still under 100,000. I know there's a lot of anticipation about that. And micro caps, these are smaller companies. They are also in an uptrend. Keeping an eye on the home builders ETF. We were getting concerned as this correlation was going down. Now it's starting to go back up. We're not really that concerned right now. Then we look at the longer term trend in China, which is down. Also, emerging markets are going down, rolling over a bit in Europe. See, they're not doing as good as the US right now. They're in a downtrend in Japan, where the US is starting to show more of an uptrend right now. Then intermarket analysis, where a week ago stocks had actually taken the lead year to date. Well, gold had a good week, and it's now back in the lead, followed by the black line, which are stocks. The green line is the dollar, the red line is oil, and the blue line are the price of bonds, all going back to the beginning of 2024. Then we look at some correlations. Pretty much neutral now when we compare the S&P to the dollar. Also neutral when we compare the S&P to oil. So are we seeing some kind of a shift going on here? And then just on the underside of being neutral when we look at the S&P to the 10-year yield, and just at the underside here with the tech sector to the 10-year yield, and then in neutral territory right now with the S&P to the 2-year yield. So if we're getting ready to shift over and look more positive, we'll see these correlations continue to change where they may go in opposite directions. Long term, still looking solid here. This is a monthly chart of the NYSE setting an all-time high, and the momentum is still up. Daily chart here with the NYSE record high percent index, really looking solid right now. And then we look at the S&P, a monthly chart here, where we saw a little bit of weakness here with the PPO, but it's starting to turn back up. And we're going to be clicking over into December. If we can have a positive close to November, that will help this chart improve. Then a daily chart of the S&P on top looking really solid, and then a ratio between stocks and commodities here, like I showed earlier, showing how stocks are outperforming longer term. And then we look at the S&P to another global index, showing how U.S. stocks are outperforming, seeing a little bit of a tick up here with the KST, but it's pretty much been flat for most of 2024. Then at the end, I go through and look at all the positive things, and I always like to explain my definition of positive. It's when the 50-day moving average is above the 200-day moving average. So when we look at growth and value alone, they are in uptrends. Copper, it's kind of hanging on to a very loose uptrend right now. The British pound and the euro, even though the dollar's been coming on strong, this could change if we still see continued dollar strength. Japanese yen also still in an uptrend, but seeing some weakness right now. Gold and silver are in uptrends. The big software companies, the mega caps, the FANG index, ARK is switching back over to an uptrend. The low volatility ETF, when you look at it alone, it is doing quite well. It's when you compare it to the S&P, it's really underperforming. Staples are in an uptrend. The Dow Jones Composite Average is in an uptrend. And then all of the bonds that we look at based on price are still in uptrends for the time being. The tech sector, high leverage loans, that's more of an economic gauge there. The Dow, the NYSE Composite, and Wilshire are in uptrends, as is the NASDAQ and NASDAQ 100. Mid caps, small caps, and micro caps, all stocks, U.S. and international stocks together. Emerging markets, kind of seeing some weakness there. And Bitcoin, which is trying to hit the 100,000. It's going to be a big party when that probably happens. Then we look at the negative side. When the 50-day simple moving average is below the 200, we have the CRB index, the dollar index, but especially the dollar could change pretty soon. And we have a new addition, the SOX index, which are the semiconductors. That's an area we want to keep an eye on. Thank you. I hope you found this helpful. I hope you have a very good weekend, and I will talk to you in the next video.